The world around us feels a bit uncertain lately, doesn't it? Interest rates shifting, currency values bouncing around, the price of, well, just about everything feeling pretty volatile.
Yeah, it does.
And in the financial world, few concepts sound more tied to that uncertainty and maybe feel more intimidating than derivatives.
Hmm.
Headlines often scream about massive wins or dramatic crashes, making them seem like these instruments of pure high-stakes gambling.
That media focus is understandable. Those stories are certainly dramatic, but it creates a really narrow picture, doesn't it?
It really does.
Derivatives are actually fundamental tools, woven really deeply into the fabric of modern finance. And they're used by everyone from huge multinational corporations down to individual investors,
Right.
and for a much wider range of purposes than just, taking big bets.
Exactly. Because they get their value from something else, right? An underlying asset, and that simple concept unlocks this whole world of possibilities for managing risk, seeking profit, or even just making markets work more smoothly.
And that's really our mission in this deep dive. Using the sources you provided to guide us, we want to peel back the layers to sort of demystify these instruments
Yeah.
and show you their versatile applications. Think of this maybe as your shortcut to understanding what's really going on when you hear about futures or options or hedging.
Yeah, absolutely. And the growth in derivatives has been, well, phenomenal, really driven by that increased volatility we mentioned
Hmm.
in things like currency, commodity prices, interest rates.
Exactly. When the world feels less predictable, the demand for tools to navigate that uncertainty just skyrockets.
Makes sense.
And you pair that with decades of financial innovation, massive leaps in technology. Derivatives have basically become the market's sophisticated answer to managing or, capitalizing on those real-world economic swings.
So over the next little while, we're going to dig into what a derivative is fundamentally, what kinds of assets they tie into, where they actually trade, the different players who use them and why they use them. And then we'll dive deep into the specifics of the most common types, like options and futures.
Yeah, and we'll use plenty of examples to make it concrete, because that's really the best way to understand these things, I think.
Definitely.
Okay, so let's start with the absolute core idea. What is a derivative, at its heart?
Yeah, what's actually behind the name?
Well, a derivative is simply a financial contract between two parties,
Mm-hmm.
but its value isn't fixed or inherent to the contract itself.
Okay.
Its worth is entirely derived from or dependent on the value of something else, and that something else is what we call the underlying asset.
Okay, so the contract itself isn't the asset, it's just tied to the asset's value somehow.
Precisely.
Yeah.
It's a bit like, think about apple juice. The price of the juice is derived from the price of apples, right?
Right.
If apples get more expensive, the juice probably will too. So a contract whose value depends on the price of apple juice is a derivative because its value is ultimately derived from that apple price, the underlying asset.
That simple connection makes sense. And this idea has just exploded in the financial world, hasn't it?
It really has. As we touched on, the big drivers are that real-world volatility, the need to hedge against big swings in interest rates, currency exchange rates, commodity prices.
Mhm.
That creates the demand.
Right, the need for protection.
Yeah. And then financial deregulation lowered barriers, technology, faster computers, global networks made trading incredibly efficient. Plus, ongoing financial engineering keeps creating new, more tailored instruments.
So it's like a continuous cycle, market responding to changing conditions.
Exactly. A market response to real-world uncertainties.
Okay, so the value is always linked to something else. What kinds of something else are we talking about? Is it just like company stocks?
Oh, far from it. The underlying asset can be surprisingly diverse. Essentially anything that has a value that fluctuates and, crucially, can be measured.
Like pretty much anything where the price moves around.
Pretty much, yeah. We can break them into categories. First, you've got the financial assets you mentioned. This covers individual stocks, think Apple or Microsoft shares, bonds, government, or corporate. And importantly, whole stock indexes like the S&P 500 or Canada's S&P TSX 60. You can actually trade a derivative based on the value of an entire index.
Wow, okay. Financial assets makes sense. What else?
Then you have commodities. These are your raw materials.
Ah, like oil and gold.
Exactly. Crude oil, gold, but also wheat, corn, soybeans, natural gas.
Hmm.
Historically, even things like pork bellies.
Pork bellies, really?
Yep. Their prices are incredibly sensitive to real-world supply and demand, weather patterns, geopolitical events, you name it.
Like a drought hitting the Corn Belt and driving up prices.
Precisely. And derivatives let people manage or, bet on those kinds of events.
All right.
We also have currencies exchange rates between different countries.
US dollar, euro.
Right. Impacted by everything from interest rates to political stability.
Yeah.
And interest rates themselves track in the level of specific rates, like treasury yields or benchmark lending rates.
So it's not just stocks, it's raw materials, money exchange rates, even the cost of borrowing money. Pretty much anything whose price changes over time.
That's the idea. While organized exchanges list specific, defined underlyings for standardization,
Right.
the over-the-counter market, which we'll get to later, can basically create derivatives based on almost anything two parties can agree on. The imagination is the limit, almost.
That's a really broad universe. Okay, so given that, why do people actually bother with these contracts? What are the main reasons?
Well, there are two fundamental drivers, really. Managing risk and seeking profit. The sources highlight three primary motivations that capture this.
And I guess risk management feels like the bedrock, the less headline-grabbing one.
It really is. Managing risk, or hedging, is arguably the most economically significant use. This is where you use a derivative to protect yourself against a potential loss from an unfavorable price movement in an asset you already have some exposure to.
So, like insurance.
It's a great analogy. You're using the derivative as a kind of insurance policy to offset an existing risk.
Can you give a really clear example of that? Maybe the farmer one.
Absolutely. Let's take that Canadian farmer expecting to harvest, say, 1,000 tons of wheat in 3 months.
Okay.
The current market price is good, but the farmer is worried that by harvest time, the price might fall sharply. That's a real business risk for them.
Right, their income depends on it.
Exactly. So they could use a derivative, maybe sell a wheat futures contract, or buy a put option to effectively lock in a selling price today for that future harvest.
So what happens if wheat prices do fall by harvest time?
Well, the farmer sells their actual physical wheat at the now lower market price.
Huh.
So they'll have a loss on that physical sale compared to today's price.
Okay.
But because they locked in a higher price with the derivative contract, that derivative position will show a corresponding gain.
Ah. So the gain on the derivative cancels out, or mostly cancels out, the loss on the actual wheat sale.
Precisely. It offsets the loss. The derivative isn't necessarily about making extra money on its own in this case. It's about reducing the uncertainty of their income from the wheat, smoothing things out.
Okay, so it's a deliberate transfer of price risk. They offload the risk of falling prices to someone else.
That's the economic function right there.
Okay, so hedging is about protecting against risk. What's the second main reason then? The flashier one.
Right, making a bet or speculation. This is the one
Oh.
that grabs the headlines. Speculators use derivatives to try and profit from correctly anticipating which way the underlying asset's price will move.
Okay.
They aren't typically managing an existing business risk like the farmer. They are taking a position specifically to make a directional bet on the price.
And this is where leverage comes in big time, right?
Precisely. Let's use that XYZ company stock from the sources. Say it's trading around $52.50. An investor thinks XYZ stock is poised to jump.
Right.
They could buy 100 shares directly, costing them $5,250.
Sure.
Or they could buy a call option. That gives them the right, not the obligation, to buy 100 shares at, say, $55 maybe before December. And the cost for that option, the premium, might be much smaller. Maybe just a few $100, say $2 per share, so $200 for the contract.
So risking much less upfront capital?
Yes, and here's the key insight about leverage. If the stock price then shoots up to $60,
Okay.
that call option giving the right to buy at $55 becomes much more valuable, often by a much larger percentage than the stock itself rose. A small move in the stock can translate into a huge percentage gain on the smaller amount of capital tied up in the option.
Okay, so potentially much bigger percentage returns compared to just buying the stock outright.
Exactly. But, and this is absolutely crucial, the flip side is just as powerful. Leverage amplifies losses too. If the stock price doesn't rise enough, or even falls, the speculator can quickly lose their entire initial investment in the option. That $200 premium could just vanish.
That's where the high-stakes reputation comes from. That potential for big wins, but also quick, total losses on the bet.
It is. Speculation with derivatives isn't just about trying to make money. It fundamentally changes the risk-reward equation. It amplifies both potential outcomes significantly.
Got it. And the third reason you mentioned?
Spotting price differences, or arbitrage. This is generally the domain of highly sophisticated professional traders with, fast systems.
Okay.
It involves finding tiny temporary discrepancies in the price of the exact same asset in different markets. Maybe the same stock is fractionally cheaper on one exchange than another for a split second.
Right.
They simultaneously buy the cheap one and sell the expensive one to capture a tiny, essentially risk-free profit before the market corrects itself, which happens almost instantly.
Yeah.
Derivatives can be tools to execute these very rapid strategies.
So the same contract that weak future, say, can be a conservative tool for the farmer and a high-risk bet for a trader.
Absolutely. For the farmer, it's price insurance. It's hedging. For a trader betting on global weather patterns affecting the wheat price, it's pure speculation. The derivative's character, whether it's conservative or aggressive, depends entirely on the user's intent and their overall strategy.
Right.
Especially when you factor in that powerful element of leverage.
Okay, that makes sense. Now, before we dive deeper into options and futures specifically, the sources lay out some really foundational concepts. These sound pretty important for really understanding how these things tick.
Right, they are indeed. Absolutely key. First, let's talk about intrinsic value.
Okay, intrinsic value, what's the idea here?
Think of it as the value of certainty, maybe. For an option, it's the immediate tangible value you'd get if you exercise that option right now.
Okay.
So if you have a call option to buy a stock at $50 and the stock is currently trading at $55 in the market,
Yeah.
that option has $5 of intrinsic value because you could exercise it, buy at $50, and immediately sell in the market at $55 for a $5 gain, right?
Right, before considering what you paid for the option.
Exactly. If exercising the option right now wouldn't make you money, like if the stock was below $50 in that example, its intrinsic value is zero.
Okay, so it's basically the in-the-money amount. Makes sense. And then there's time value.
Yes, and this you could call the value of uncertainty, or maybe the value of potential. This is the part of an option's price, the premium, that is above its intrinsic value.
Above the immediate value, why would it have extra value?
Because there's still time left before the option expires. Time value reflects the market's expectation or hope that the underlying asset's price could move favorably before the option expires.
Ah, okay. So the more time left until expiry, or maybe the more volatile the underlying asset's price is expected to be,
Exactly.
the higher the time value?
Generally, yes. More time means more opportunity for a favorable price swing.
Yeah.
Higher volatility means those potential swings could be bigger, so people are willing to pay more for that possibility.
But that time value doesn't last forever, right?
No, absolutely not. It constantly erodes as the expiration date gets closer. That's called time decay, or the Greek letter theta.
Time decay.
Yeah, it's a crucial factor because it constantly works against the option buyer. It eats away at the option's value if the underlying price doesn't move enough or fast enough in their favor. It's the friend of the option seller, though.
Interesting. So intrinsic value is the now value. Time value is the potential value that fades away over time. And we keep coming back to leverage.
Because it's absolutely central to how derivatives function, especially options and futures. Leverage is using a relatively small amount of capital to control a much larger value of the underlying asset.
Right.
Putting down that small option premium or posting the futures margin gives you exposure to the potential profit and loss of owning or selling a large amount of stock or currency or barrels of oil.
And we really can't say this enough. Leverage amplifies everything.
Exactly. A small percentage move in the underlying asset's price can result in a very, very large percentage gain or loss on the capital you actually put down for the derivative position.
Right.
And with some derivatives like futures or selling options naked, you can actually lose significantly more than your initial deposit.
Which is why understanding this is just non-negotiable before trading these things.
Absolutely. It's critical. Finally, there's the concept of a zero-sum game.
Ah, the idea that for every winner, there's a loser.
From a purely financial perspective, yes. If you ignore transaction costs, the total financial gain across all participants in a specific derivative contract nets out to zero. What one party gains in dollars, the other party loses in dollars.
But you added a key nuance earlier with the farmer hedging. It's not always just about the dollars.
Right. That's the important distinction. While the dollar outcome might be zero-sum, the economic utility or value derived is often not.
How so?
Well, take the farmer again. They buy a put option to protect their wheat price. If the price stays high and the option expires worthless, the farmer has a financial loss, the premium they paid.
Right.
But they willingly paid that premium as the cost of price insurance. They achieved valuable certainty for their business planning, which has real economic utility for them.
Oh, okay.
The speculator who sold them the put option and kept the premium had a financial gain. But both parties, arguably, got what they wanted. The farmer transferred risk they didn't want, and the speculator took on that risk, hoping for a profit.
That framing makes much more sense. It's a transfer of something valuable risk, even if the net cash flow between the two is zero at the end.
Yes. So mastering these core concepts, intrinsic value, time value, leverage, and the zero-sum dynamic with its utility nuance is really key to grasping the specifics of the different derivative instruments we're about to discuss.
Okay, good foundation. So with all this happening, where do these contracts actually get traded? Is it just like back rooms and phone calls between big banks?
Well, that's part of it. There are two major distinct environments where derivatives trade. There's the over-the-counter OTC market, and then there's the exchange-traded market.
Okay, let's start with the OTC market. What's that like?
Think of this as the custom shop, maybe. It's not a physical location like a stock exchange. It's more of a decentralized network, primarily made up of large financial institutions, big banks, investment dealers trading directly with each other and with large corporate clients.
So, not listed publicly.
No. Transactions are typically negotiated privately, often over sophisticated phone systems or private computer networks.
So the big advantages are privacy and customization.
Exactly. The biggest advantage is flexibility. Contracts can be precisely tailored to a client's unique needs-specific, non-standard amounts, unusual expiry dates, maybe an underlying asset that isn't listed on an exchange. They're also inherently private and generally less regulated than exchanges, which allows for rapid innovation in creating new types of products.
Okay, flexible, private. But what are the trade-offs? There must be some downsides.
The major one is default risk, often called counterparty risk.
Meaning the risk that the other side won't pay up?
Precisely. Since it's just the two parties involved in the contract, there's a risk that one might fail to fulfill their obligation if the market moves significantly against them and they can't cover the loss. This is why OTC participants are typically large, financially stable institutions.
Okay.
And because the contracts are custom-made, they also tend to have lower liquidity. It can be harder to sell or transfer a bespoke OTC contract to someone else if you want out before expiry, compared to a standardized one. Performance bonds are sometimes used to mitigate that default risk, though.
Okay, so OTC. Flexible, private, innovative, but higher counterparty risk and less liquid. What about the alternative, the exchange-traded markets?
This is the more organized marketplace. Think of places like the Montreal Exchange in Canada or the CME Group in the US. They provide a central infrastructure, set clear rules, and offer significant transparency and safeguards. They were developed in large part to address the risks inherent in OTC trading.
And the defining feature here is standardization, you mentioned.
Crucially, contracts traded on exchanges have predefined, uniform terms, specific contract sizes, like 100 shares for a stock option or 1,000 barrels for an oil future, set expiry dates, defined quality standards for commodities. This standardization is key.
Why is it so important?
Because it makes the contracts fungible. That just means one contract is identical to and interchangeable with any other contract of the same type.
Ah, so they're not unique like the OTC ones.
Exactly. And that leads directly to greater contracts. Transparency prices and trading volumes are public information and high liquidity. Because the contracts are identical, it's very easy to get out of your position before expiry by simply making an offsetting transaction.
Name.
If you bought a contract, you just sell an identical contract to close out. If you sold one initially, you buy an identical one back. The two positions cancel each other out. This makes it easy to enter and exit positions quickly.
Okay, standardized, transparent, liquid. But how do they tackle that big default risk problem from the OTC market?
This is the absolute cornerstone of exchange-traded markets and a massive advantage. Default risk is dramatically reduced thanks to the role of the clearinghouse or clearing corporation, like the Canadian Derivatives Clearing Corporation, CDCC.
The clearinghouse, what do they do?
The clearinghouse cleverly inserts itself into the middle of every single trade. It becomes the buyer to every seller and the seller to every buyer.
Wait, so I'm not actually trading directly with the person on the other side. I'm trading with the clearinghouse.
Effectively, yes. Your legal counterparty becomes the clearinghouse itself. It guarantees the performance of the contract to both original parties. So you're no longer worried about whether the specific person you traded with can pay up. You're relying on the financial strength of the clearinghouse.
Wow, okay. That's a huge difference. How does the clearinghouse protect itself from risk then?
Excellent question. They use two main tools. requiring margin from all participants.
Margin, like a deposit.
Exactly, a good faith deposit or performance bond. And the absolutely vital process of marking to market.
You mentioned that earlier. Tell me more about marking to market.
Marking to market is the daily settlement of gains and losses on open futures positions. At the end of each trading day, the clearinghouse values every open contract at the official closing or settlement price.
Okay.
If your position had a favorable price move that day, your margin account is credited with the day's gain. If the price moved against you, your account is debited the day's loss. This happens every single trading day.
So the losses are taken out of your account immediately, daily.
Yes. And if those daily losses cause your account balance to fall below a certain minimum level of the maintenance margin, you get a margin call.
Uh-oh.
Yeah, that means you must deposit additional funds immediately to bring your account balance back up, usually to the initial margin level. This daily settlement, backed by the margin deposits, is crucial. It ensures that any potential losses for the clearinghouse are covered pretty much as they happen, preventing small losses from snowballing into huge defaults that could threaten the entire system.
Okay, so the clearinghouse guarantees the trade, and margin plus marking to market is how they manage the immense risk of doing that. That connection makes a lot of sense now.
It's the engine of safety and stability for exchange-traded derivative markets. And these markets are also, as you'd expect, extensively regulated.
Okay, so wrapping up the markets. OTC is the custom shop, flexible, private, less regulated, but carries higher default risk and lower liquidity. Exchange traded is the standardized, factory transparent, heavily regulated, very low default risk thanks to the clearinghouse, and highly liquid because everything's interchangeable.
That's a great summary. And they coexist because they serve different complementary needs. Exchanges are great for high-volume accessibility and standardized hedging or speculation, including for retail investors. OTC is essential for large institutions and corporations needing large, complex, bespoke contracts that just aren't available on an exchange. It's always this balancing act in finance between customization and innovation versus standardization and safety.
Okay, markets covered. Now, who are the different people and companies actually using these tools? You mentioned individuals, institutions, businesses, and dealers earlier.
Right. We can look at them in roughly 4 main groups, and their motivations often dictate which market, OTC, or exchange, and which specific instruments they tend to prefer.
Let's start close to home. Individual investors, like maybe some of us listening.
Individuals primarily interact with derivatives through the exchange-traded markets, mostly using options and sometimes futures. Their motivations typically span both speculation, trying to profit from anticipated price moves, using leverage,
Right, the betting aspect.
and also risk management. For example, buying put options to protect a stock portfolio they already own against a market downturn.
So making directional bets or getting some portfolio insurance.
Exactly. Now, the sources really emphasize a crucial point for individuals. These instruments can be powerful, yes, but they come with significant risks. You should absolutely only use them if you fully understand the potential rewards and, critically, the potential losses involved.
Especially with leverage.
Especially with leverage. Speculation offers the potential for magnified gains, but also substantial losses, sometimes even exceeding your initial investment, particularly with futures or naked option writing. It requires a high tolerance for risk and, frankly, the financial capacity to absorb those potential losses without devastation. You really need a licensed broker and advisor to guide you.
Yeah, a healthy dose of caution is definitely required there. Okay, what about the big players, the institutional investors?
These are the sophisticated entities: pension funds, mutual fund managers, hedge funds, insurance companies, university endowments, and so on. They operate in both the exchange-traded markets and the more complex OTC market.
And I assume they're using derivatives for hedging and speculation too, but probably on a massive scale and with maybe more complex goals.
Exactly right. Beyond straightforward hedging and speculation, they use derivatives for a whole range of advanced strategies. For instance, efficiently shifting large blocks of assets or exposures between markets, what's sometimes called market entry-exit.
How does that work?
Well, imagine a large fund wants to reduce its exposure to, say, the UK stock market and increase its exposure to the French and German markets. Instead of selling thousands of individual British stocks and buying thousands of French and German ones, which is slow and costly,
Right.
they might achieve a similar economic effect much faster and cheaper by using index futures. They could sell futures contracts on a UK stock index and simultaneously buy futures contracts on French and German stock indexes.
Much quicker and more efficient for big portfolio shifts.
Exactly. They also actively engage in arbitrage when those tiny price discrepancies pop up. And they employ various strategies for yield enhancement.
Yield enhancement, like getting extra income.
Yeah, a common example is selling covered call options against the stocks they already hold in their portfolios to earn additional income from the option premiums received. We'll talk more about covered calls later.
Okay, so individuals use them for maybe simpler speculation or basic hedging. Institutions use them for complex strategies, large-scale portfolio management, sophisticated hedging, arbitrage, income generation, all sorts of things. How about actual businesses and corporations? The non-financial companies.
This is where hedging truly shines as the overwhelmingly dominant motive. Think about large operating companies, airlines, manufacturers, exporters, importers, resource producers. They face unavoidable financial risks just from doing their core business.
Like what kind of risks?
Risks related to fluctuating interest rates on their corporate debt,
Yeah.
currency risk if they buy supplies or sell goods internationally, or commodity price risk for the raw materials they need to buy or the products they sell.
Right, like the airline needing jet fuel or the farmer selling wheat we talked about.
Perfect examples.
Yeah.
Or consider a Canadian company that exports goods to Europe. They'll receive payment in euros in, say, 3 months. They face the risk that the euro might weaken against the Canadian dollar before they get paid, reducing their revenue in SU terms. They can use a currency derivative like a forward contract, or maybe a currency option, to lock in an exchange rate today, protecting themselves against that potential depreciation.
Or a company with floating rate debt.
Yeah, they might use an interest rate derivative, like an interest rate swap or cap, to protect against their borrowing costs soaring if interest rates climb unexpectedly.
So their primary goal isn't really to make money trading derivatives itself.
Generally not.
It's to protect their core business operations and profits from unpredictable swings in financial markets. They want stability and predictability.
Precisely. It's often considered good corporate governance and prudent financial management to mitigate these significant pre-existing business exposures. They are managing existing risks tied to their operations, ideally not creating new, purely speculative ones through derivative trading.
Got it. And who facilitates all these trades? Who's in the middle?
Those are the derivative dealers. These are primarily the large commercial and investment banks and securities dealers. They act as intermediaries, essentially standing ready to buy from sellers and sell to buyers.
So they're making the market.
Exactly. On exchanges, they often act as designated market makers, providing crucial liquidity by quoting both buy bid and sell ask prices. Their business model is generally based on earning income from the volume of transactions they handle or the difference between their buy and sell prices, the bid-ask spread, rather than taking massive directional bets themselves. They aim to balance their own risk exposures.
And in the OTC market.
In the OTC market, they are essential. They are the ones creating those custom-tailored contracts needed by corporations and institutions, and they typically take the other side of those trades initially, managing the resulting risk through sophisticated internal hedging strategies. They are critical facilitators of that risk transfer process between end users.
So it really is an ecosystem, isn't it? You've got the hedgers who want to get rid of risk, the speculators who are willing to take on that risk for a potential profit,
Right.
and the dealers in the middle making the connections, creating the instruments, providing liquidity, and managing the flow.
That's the dynamic in a nutshell.
Mm.
And generally, the complexity of the user's needs and their level of financial sophistication often determine which markets exchange or OTC they primarily access. Individuals mostly stick to exchanges. Large institutions and corporations use both.
Okay, fantastic overview. Let's dive into the actual instruments now. Options seem like a really great place to start, given how often you hear about them.
Absolutely. Options are fascinating and unique because they involve a right, not an obligation, for one of the parties. That's the key.
Right, not obligation.
Yeah. An option is fundamentally a contract between a buyer, who we call the holder, and a seller, who we call the writer. The buyer pays a fee up front, that's the option premium to the seller.
Okay.
In return for that premium, the buyer gets the right to do something specific. Buy or sell an underlying asset at a set price within a certain time frame. The seller, having received the premium, takes on the obligation to fulfill the contract if the buyer chooses to exercise their right.
So the buyer has the choice, the power to decide. The seller just has to wait and see if the buyer acts.
That's the core asymmetry. The buyer pays for that flexibility, that choice. The seller accepts the potential obligation in exchange for receiving that premium income up front.
And the two main types. calls and puts.
Exactly. Call options and put options. Let's start with calls. A call option gives the holder the right to buy the underlying asset at a specific predetermined price called the strike price or exercise price on or before the option's expiration date.
Okay, right to BUY, like maybe putting a non-refundable deposit on a house to lock in the option to buy it later at today's agreed price.
That's a perfect analogy. You pay a fee, the deposit premium, to secure your ability to buy at that set price, $50 strike, say.
Hmm.
If the market price of the house, the stock, goes way up to $60, your right to buy at $50 becomes really valuable.
Right.
But if the market price falls to $40, you're not forced to buy at $50. You just walk away,
Yeah.
losing only your initial deposit, the premium. So a call buyer is generally expecting or hoping the underlying asset's price will rise.
Makes sense. And a put option is the opposite.
Pretty much. A put option gives the holder the right to sell the underlying asset at that specific strike price, again, on or before the expiration date.
Okay, right to sell. So if I own some stock, buying a put is like buying insurance against the price falling.
Exactly like insurance.
Yeah.
Think about car insurance. You pay a premium each year. If your car, your stock, gets damaged and loses value, the stock price falls. Your insurance policy, the put option, gives you the right to effectively sell it back at a higher insured value, the strike price, limiting your financial loss. So, a put buyer is generally expecting or hoping the underlying asset's price will fall.
Okay, so just to be crystal clear, there are these 4 basic positions, right?
Uh-huh.
You can buy a call, sell a call, buy a put, or sell a put.
Exactly. And understanding who has the right and who has the obligation and what their basic expectation is for the price move is absolutely key. If
Yeah.
you buy a call, long call, you pay the premium, you get the right to BUY at the strike price, and you generally expect the price to rise.
Okay.
If you sell,
Right.
a call, short call, you receive the premium, you take on the obligation to sell at the strike if exercised, and you generally expect the price to stay the same or fall.
Right.
If you buy a put, long put. You pay the premium, you get the right to sell at the strike, and you
Oh.
generally expect the price to fall. And if you sell, a put, short put, you receive the premium, you take on the obligation to BUY at the strike if the buyer exercises, and you generally expect the price to stay the same or rise.
That 4-part structure based on call put and buy sell makes a lot of sense when you lay it out like that.
It's all built on that fundamental right versus obligation asymmetry, driven by who pays and who receives the premium.
And there's specific terminology around how options are described when you trade them.
Yes, there's a standard format you'll see. It usually includes the number of contracts, the underlying asset, the expiration month, the strike price, and whether it's a call or a put.
So something like,
Buy 5 XYZ December 55 calls. That tells you you're buying 5 option contracts on XYZ stock. They expire in December, and they give you the right to buy the stock at a $55 strike price.
and each contract usually covers a set amount of the underlying.
Yes. For stock options in North America, one contract typically represents 100 shares of the underlying stock. That's the standard trading unit. So that buy 5 XYZ Dick 55 calls actually gives you the right to buy 500 shares. 5 contracts, 100 shares contract.
Ah, okay. So the price quoted, the premium, is per share, but the actual cost is that premium times 100.
Exactly. If the premium is quoted at $2, the cost for one contract is $2 to 100. $200, plus commissions, of course.
Good to know. What are the other essential pieces of option lingo we need?
Okay, besides call and put, we've covered strike price or exercise price, the fixed transaction price. We've covered the option premium, the price the buyer pays the seller, which is the max loss of the buyer and max initial gain for the seller.
Right.
Then there's the expiration date, the absolute last day the option is valid.
Right.
After this date, it's completely worthless. We mentioned the trading unit, usually 100 shares.
Okay. What about American versus European style? I've heard those terms.
Good one. American-style options can be exercised by the holder at any time up to and including the expiration date. Most individual stock options traded in North America are American-style.
Okay. Flexible exercise.
European-style options, on the other hand, can only be exercised on the expiration date itself, not before.
Ah, yeah.
Many stock index options are European-style.
Only on the last day. Got it. And AAPS, what are they?
LAPS stands for Long-Term Equity Anticipation Securities. Fancy name. But they're simply options with much longer times until expiration, typically more than a year, sometimes several years out.
Okay, just long-dated options. And what's the typical life cycle of an option trade? What happens after you buy or sell one?
Well, it starts with an opening transaction, either buying to open or selling, ready to open a position. Then, during the life of the option, before it expires, a few things can happen.
Okay.
The most common outcome, especially for exchange-traded options held by speculators, is to close the position with an offsetting transaction.
Like we discussed for futures.
Exactly. If you bought a call, you sell that same call to close. If you wrote a put, you buy that same put back to close. Your net position becomes zero.
So you lock in your profit or loss without dealing with the underlying stock.
Precisely. Alternatively, the holder, the buyer, might decide to exercise their rise, use the call to buy the stock, or use the put to sell the stock at the strike price.
Right.
If the holder exercises, then the writer, the seller, is notified that they've been assigned. Assignment means they now have the obligation to fulfill the contract. The call writer must sell the stock at the strike, and the put writer must buy the stock at the strike.
Okay, exercise and assignment. And what if none of that happens by the final day?
Then, at the end of the expiration date, if the option hasn't been exercised, usually because it's not worth exercising, it simply expires worthless. The buyer loses the premium they paid, and the seller keeps the premium they received initially as their profit.
Okay, so most options, especially speculative ones, just get offset or expire worthless. Exercise is less common.
Generally, yes, offsetting is often more efficient, especially for capturing any remaining time value. And many options, particularly those bought far out of the money, simply expire worthless.
Speaking of worthless, how do you know if an option is worth exercising? Or if it has that intrinsic value we talked about? Is that where in, out, or at the money comes in?
Exactly. And that concept called moneyness is crucial. It describes the relationship between the option strike price and the current market price of the underlying asset. It tells you if exercising right now would be profitable before considering the premium you paid.
Okay, so what's in the money, ITM?
An option is in the money if exercising it right now would result in an immediate profit on the underlying transaction. It has positive intrinsic value.
So for a call option.
A call is ITM if the underlying stock price is above the strike price. If XYZ stock is trading at $60, a $55 strike call is $5 ITM. $60 is greater than $55. You have the right to buy at $55 something worth $60.
And for a put option.
A put is ITM if the underlying stock price is below the strike price. If XYZ stock is trading at $45, a $50 strike put is $5 ITM. $45 is less than $50. You have the right to sell at $50 something worth only $45. Holders generally only consider exercising options that are ITM.
Makes sense. So out of the money, OTM is the opposite.
Correct. An OTM option is one where exercising it immediately would result in a loss on the underlying transaction. It has zero intrinsic value. A call is OTM if the underlying price is below the strike. A put is OTM if the underlying price is above the strike. OTM options almost always expire worthless if they stay OTM.
And at the money, ATM.
That's when the underlying price is exactly equal to the strike price. Like ITM options, ATM options also have zero intrinsic value, and they also generally expire worthless.
Okay, ITM, OTM, ATM. That seems fundamental to understanding their immediate value, or lack thereof. And the actual price of the option, the premium, is made up of those two pieces we discussed earlier. Intrinsic value plus time value.
Precisely. That's the formula. Option premium, intrinsic value plus time value. We just defined how to figure out the intrinsic value. The option is ITM, or zero if it's OTM or ATM.
So using that $60 XYZ stock example again.
Right. If XYZ stock is $60, a $55 strike call is $5 ITM, so its intrinsic value is $65 ITM, so its IV is $5, $65 or $60. $65 strike call, OTM, or a $55 strike put, OTM, would both have $0 IV.
Okay. And the time value is just whatever is left over in the premium after accounting for the intrinsic value.
Exactly. You calculate it simply. Time value, option premium, intrinsic value. So if our XYZ $50 call with $5 IV is trading in the market for a premium of $6,
Yeah.
then its time value is $6 premium, $5 weather dollars. That extra $1 represents the market's price for the possibility that the stock might go even higher before the option expires, plus factors like volatility and interest rates.
And that $1 of time value will decay as expiration gets closer.
Yes, that time value constantly erodes, especially accelerating in the last few weeks or month before expiration. That's the time decay, theta, working against the buyer and for the seller. Think of time value as the buyer's payment for hope or potential, and the seller's compensation for taking on the risk over that time.
Okay, premium equals intrinsic value plus time value. Got it. You also briefly mentioned reading option quotes.
Yeah, when you look up options prices, you'll typically see the strike price, expiry, the current bid price, what buyers are willing to pay, an ask price, what sellers are asking, the last traded price, the daily volume, how many contracts traded, and the open interest. total number of contracts currently outstanding. High volume and open interest generally indicate good liquidity.
Good info. Okay, this is a great background. Now let's get really practical. Can we walk through some common strategies using these options, maybe with those XYZ Inc. examples from the sources?
Absolutely. Options offer a vast array of strategies, from simple to incredibly complex. Let's focus on some core uses for speculation and risk management, using XYZ stock trading at $52.50 as our baseline. And we'll ignore commissions and other costs for simplicity here.
Sounds good. First up, buying call options. Why would someone do this?
Two main reasons, typically. One, pure speculation, betting the stock price will rise significantly using leverage. Two, risk management, maybe to lock in a maximum purchase price for stock you plan to buy later or to protect a short position.
Okay, let's take the speculation angle first. Using calls for that leveraged bet on the upside.
Right. You think XYZ stock, $52.50 is going to go up. Instead of buying 100 shares for $5,250, you decide to buy, say, one December 55 call contract for a premium of $2 per share. That costs you $200, but 100 shares. This call is slightly out of the money, OTM, because the strike, $55, is above the current price, $52.50.
Okay, $200 invested. What happens if you're right and the stock goes up?
Let's say XYZ stock rises to $60 before December expiry. Your call option is now nicely in the money. $60 stock price, $55 strike equals $5 IV. It will also likely still have some time value left. Let's say the option is now trading at $6.70, maybe $5 IV plus $1.70 TV.
Okay.
You can sell your option contract for $6.70 per share, which is $6.70 total. You pay $200, so your profit is $470.
Not bad on a $200 investment. Now, let's see the leverage illustration here compared to owning the stock.
Good point. The stock went from $52 to $60. That's a $7.50 gain, or about a 14.3% return if you'd bought the shares.
Okay, 14.3% on the stock.
Your option went from $2 to $6.70. That's a $4.70 gain on a $2 investment. That's a 235% return. Much, much higher percentage gain because you controlled 100 shares worth of upside potential with only $200 at risk initially.
Wow, 235% versus 14.3%. That really shows the power of leverage. But what if you were wrong? Stock falls.
All right, the downside. Let's say XYZ stock falls to $45 instead. Your December 55 call is now deep OTM. It's essentially worthless, maybe trading for a tiny time value, say 7 times 25 total. You sell it for that or let it expire worthless. You paid $2, you get back $0.25. Your loss is $1.75 per share or $175 total.
So you lost most of your $200 investment. How does that compare percentage-wise?
The stock fell from $52 to $45, which is a $7.50 loss, or a 14.3% loss on the stock investment. Your option went from $2 to 25 cents. That's a $1.75 loss on the $2 investment. That's an 87.5% loss.
So again, leverage magnified the outcome. A 14.3% stock loss turned into an 87.5% option loss. Cuts both ways sharply.
Precisely. Leverage amplifies gains A&D losses dramatically. Also note, in the winning scenario, selling the option for $6.70 captured the remaining time value, $1.70. If you'd exercise instead, you'd only capture the intrinsic value, $5. So selling is often better.
Good tip. Okay, so that's speculation. How about using call buying for hedging, like setting a max purchase price?
Yeah, imagine a fund manager knows they need to buy, say, 50,000 shares of XYZ for their portfolio in December, but they're worried the price might surge before then. Stock's $52.50 now.
Okay.
They could buy 500 XYZ December 55 got. Calls today may be paying that $2 premium, $100,000 total premium cost for 50K shares exposure. This acts like a price ceiling guarantee.
How so?
If XYZ jumps to $60 by December, their calls are $5 ITM. They can exercise the calls, buying the 50,000 shares at the $55 strike price. Their total cost per share is the $55 strike plus the $2 premium they paid, so $57. That's better than having to buy at the $60 market price.
And if the stock falls instead to $45?
If XYZ falls to $45, the calls expire worthless. They lose the $100,000 premium they paid. That's the cost of their price insurance. But now they can just buy the 50,000 shares in the open market at the lower $45 price. Their effective cost is $45 market price plus $2 lost premium, explains $47 per share. The option protected them from the upside price risk.
So it caps their potential purchase price, like insurance. Okay. One more hedging use for buying calls. Protecting a short sale.
Yeah. Right. Selling short means you borrow shares and sell them, hoping the price falls so you can buy them back cheaper. But if the price rises, your potential loss is unlimited.
Scary.
So a short seller who sold 500 XYZ shares at $52.50 might simultaneously buy 5 December 55 cents. calls for $2, $1,000 premium as protection against a price surge.
How does that protect them?
If XYZ stock unexpectedly jumps to $60, their short position is losing money fast. But their calls are now $5 ITM. They can exercise the calls, buying the 500 shares at $55 to cover their short position and limit the damage. Their net buying price is $57, $55 strike plus $2 premium. So their loss in the short sale is capped at $4.50 per share, $57 by price, $52.50 in initial short price.
Yes.
Much better than having to buy back at $60.
And if the stock falls like they hoped, to $45.
If XYZ drops to $45, the calls expire worthless. They lose the $1,000 premium. But they can now buy back the shares in the market at $45 to cover their short. Their effective buyback price is $47, $45 market plus $2 less premium. They still make a profit on their short sale of $5.50 per share, $52.50 initial short price, $47 effective buy price. The call limited their upside risk on the short.
Okay, buying calls. Leveraged bet on up, or protection against price increases, either for buying later or covering a short. Now, what about the other side? Writing, selling call options. What's the goal there?
The primary motivation for selling calls is usually to generate income from the premium received. The writer collects the premium up front and hopes the option expires, worthless so they can just keep it.
And you mentioned two main ways, covered calls and naked calls. Let's start with covered calls. What makes them covered?
Covered means the call writer already owns the underlying shares that they might be obligated to sell if the call is exercised. This is a very common strategy for investors holding stock.
So owning the stock covers the obligation.
Exactly. Let's say you own the 1,000 shares of XYZ that you bought way back at $40 per share. The stock is now trading at $52.50. You think it might not go much higher in the short term, so you decide to generate some income.
Okay.
You could sell 10 September 50 calls, covering your 1,000 shares, and receive a premium, say $4.55 per share, $4,555 total premium. Note these calls are slightly in the money, $52.50 strike. That $4.55 premium might be composed of $2.50 intrinsic value, $52.50, and $2.05 time value.
Okay, you received $4,550 up front. What happens next?
Depends on the stock price at expiry.
Right. Scenario 1. XYZ stock is above $50 at September expiry, say it's $55. The calls you sold will be exercised by the buyers. You will be assigned, meaning you must sell your 1,000 shares at the $50 strike price.
So you own your shares.
You do, but look at your effective selling price. You got $50 per share from the sale, plus you kept the $4.55 premium you received up front. So your effective sale price is $54.55 per share. Compared to your original $4 cost basis, that's a nice profit of $14.55 per share, $14,550 total. Okay, so a profitable exit, even though you sold at $50. What's the catch?
The catch, or opportunity cost, is that you forego any potential stock gains above your effective selling price of $54.55. If the stock had rocketed to $60, you still only got $54.55. You capped your upside.
Got it. What's scenario 2? Stock stays below $50.
Let's say XYZ stock drifts down to $48 by September expiry. The September 50 calls you sold are now OTM and will expire worthless.
So the buyers don't exercise.
Right. You are not assigned. You simply keep your original 1,000 shares of XYZ, and you keep the entire $4,550 premium you collected. That premium effectively reduces your cost basis on the stock. Your original cost was $40, subtract the $4.55 premium per share, and your new effective cost basis is $35.45.
Ah, so the premium provided some downside protection. If the stock dropped, the premium helped cushion the blow.
Exactly. Covered calls are often viewed as a way to generate income on stocks you already own, while providing a limited buffer against small price declines in exchange for giving up potential upside gains beyond the strike price plus premium. Generally considered a more conservative option strategy because you own the underlying.
Okay, covered calls make sense for stock owners looking for income. Now, the scary one. Naked calls. What makes them naked?
Naked means you sell the call option without owning the underlying stock to deliver if you get assigned. You have no cover. This is highly risky.
Why is it so much riskier than covered calls?
Because if the stock price rises significantly and the call you sold gets exercised, you are obligated to sell shares that you don't own. To fulfill that obligation, you first have to buy the shares in the open market at the current high price, only to immediately sell them at the lower strike price specified in the call contract.
Ouch.
Let's use the same example. You sell 10 September $50, calls naked, collecting $4,550 premium. You're just hoping XYZ stays below $50, but what if it surges to $60 by expiry?
The calls get exercised.
Right. You are assigned, you must deliver 1,000 shares at $50. Since you don't own them, You have to go into the market and buy 1,000 shares at the current price of $60. That costs you $60,000. You immediately sell them for $50,000 per your obligation. That's a $10,000 loss right there, $10 per share.
Wow.
Now, you did collect $4,550 in premium initially. So your net loss is $10,000 loss, $4,550 premium. It's a loss of $5.45 per share.
That's a significant loss, but what's the absolute worst case?
This is the critical warning. The maximum loss for a naked call writer is theoretically unlimited. Why?
Right.
Because there's no theoretical limit to how high a stock price can rise. If XYZ went to $100 or $200, your losses would just keep mounting as you're forced to buy high and sell low.
Unlimited loss potential. Okay, that definitely explains the high-stakes gambling headlines sometimes. Clearly, naked call writing is only for extremely sophisticated investors with very deep pockets and a very high tolerance for risk.
Absolutely. It's one of the riskiest option strategies out there.
Okay, moving on. Let's talk about buying put options. What are the main reasons for doing that?
Similar logic to calls, but in reverse. 1. Pure speculation, betting the stock price will fall significantly using leverage. 2. Risk management, specifically to ensure a stock holding you already own against a price drop.
Let's do speculation first, betting on the downside with puts.
Right. You think XYZ stock $52.50 is going to tank. Instead of shorting the stock, which has its own risks and margin requirements, you buy put options. Let's say you buy 10 September 50 cents puts for a premium of $1.50 per share, $1,500 total cost for the right to sell 1,000 shares at $50. These puts are slightly OTM, $50 strike, $52.50 stock.
Okay, $1,500 invested for the downside bet. What if you're right and the stock falls hard?
Let's say XYZ plunges to $45 before September expiry. Your September 50 puts are now nicely ITM, $50 strike, $45 stock, it's $5 IV.
Okay.
With some time value maybe, let's say they're trading at $5.25, $5 IV plus 25 TV.
Okay.
You sell your 10 put contracts for $5.25 per share, $5,250 total. You paid $1,500 initially. Your profit is $3.75 per share, or $3,750 total.
Again, significant return on the initial investment due to leverage. What if you were wrong and the stock went up?
If XYZ stock rises to $60 instead, your September 50 puts are deep OTM. They'll be worthless or very close to it, maybe trading for dollars or $50 total. You sell them for that tiny amount or let them expire worthless. You paid $1.50, so you get back maybe 0 to 5 cents. Your loss is $1.45 per share or $150 total.
So just like buying calls, your maximum loss when buying puts is limited to the premium you paid up front.
Exactly. The most you can lose is the $1,500 you invested. That defined risk is appealing compared to shorting the stock directly, where the loss potential is theoretically unlimited if the stock rises.
Okay, so buying puts is a leveraged bet on the downside, with risk limited to the premium. How about using puts for hedging, that insurance idea, the married put or put hedge?
Right. This is when you own the underlying stock and you buy put options on it to protect yourself against a price drop. It's like buying insurance for your shares.
So say you own 1,000 shares of XYZ, $52.50, and you're worried about a market correction.
You could buy 10 September 50 puts, paying that $1.50 premium, $1,500 total cost. This gives you the right to sell your 1,000 shares at $50 no matter how low the market price goes.
Okay, so what happens if the stock does fall to $45 again?
If XYZ drops to $45, your shares have lost value. But your puts are now $5 ITM, $45. You can exercise the puts, which forces the put writer to buy your 1,000 shares from you at the $50 strike price.
So you sell at $50 even though the market is $45?
Yes. Your effective selling price is the $50 strike minus the $1.50 premium you paid for the put, so $48.50 per share. Much better than having to sell at the $45 market price. The put essentially established a minimum selling price floor for your stock minus the cost of the put.
That's clear downside protection. What if the stock goes up instead?
If XYZ rises to $60, well, that's great for your stock holding. Your September 50 puts will expire worthless because they're deep OTM. You lose the $1,500 premium you paid for them.
So the insurance wasn't needed and you lost the premium cost.
Exactly. You paid for protection you didn't end up needing, just like paying for car insurance in a year you don't have an accident. But you still benefit fully from the stock's appreciation. Minus that premium cost, it's a trade-off. Paying a premium to limit downside risk means reducing your potential upside profit by that premium amount.
Makes sense. Okay, final basic position. Writing. Selling put options. Why do people do this?
Two main goals usually drive put writing. 1, to generate income from the premium received, hoping the put expires worthless. Two, as a way to potentially acquire the stock at a price lower than the current market price.
Acquiring stock, how does that work? Let's talk about the safer version first, the cash-secured put.
Right. Cash secured means when you sell the put, you simultaneously set aside enough cash in your account to actually buy the shares at the strike price if the put buyer decides to exercise and assigns the shares to you.
So you're prepared to buy the stock.
Exactly. Let's say XYZ is $52.50. You'd actually be happy to buy 500 shares, but you think maybe you can get it a bit cheaper. You decide to sell 5 December 55 puts and collect a premium, say $4.85 per share, $2,425 total premium up front. These puts are currently ITM, $55 strike, $52.50 stock. Simultaneously, you earmark $27,500 in cash, $55 strike, 500 shares, to cover the potential purchase.
Okay, you got $2,425 premium, and you have the cash ready. What happens next?
Scenario 1. XYZ stock stays below the $55 strike price at December expiry. Let's say it's $50. The puts you sold are ITM, and the buyer will likely exercise them. You will be assigned.
Meaning you must buy the shares.
Yes. You are obligated to buy 500 shares of XYZ at the $55 strike price using the $27,500 cash you set aside.
But the market price is only $50, so you paid $55.
You paid $55 per share, yes. But remember that $4.85 premium you received up front. Your effective purchase price is the $55 strike minus the $4.85 premium, which equals $50.15 per share.
Ah, so you ended up buying the stock for an effective price of $50.15, which is actually lower than the $52.50 it was trading at when you sold the put.
Exactly. You either get to keep the premium if the stock stays high, or you get assigned and buy the stock you wanted anyway, but at an effective price below where it was when you started the trade. That's the appeal of the cash-secured put strategy for someone bullish on a stock long-term.
Okay. And scenario 2. Stock is above $55 at expiry. Say $58.
If XYZ is $58 at expiry, the December 55 puts you sold are OTM and will expire worthless. The buyer won't exercise their right to sell you stock at $55 when the market price is $58.
So you don't have to buy the shares?
Correct. You are not assigned. You simply keep the entire $2,425 premium you collected initially as pure profit, and you keep the $27,500 cash you had set aside. You made income, and you're free to try the strategy again or just buy the stock outright if you still want it.
So with a cash-secured put, you either collect the premium as income if the stock stays up, or you essentially get paid to wait and potentially buy the stock you wanted at a discount if it falls below the strike. Seems like a win-win if you wanted the stock anyway.
For investors who are comfortable owning the stock at the effective purchase price, it can be an attractive strategy. The risk is that the stock could fall much further than the strike price, and you'd still be obligated to buy at the strike, though your effective price is lower due to the premium.
Right. Now, the risky version, naked put writing.
Yes. Selling a put naked means you sell it without fully securing the cash needed to buy the shares if assigned, or without having an offsetting short stock position. You're basically just hoping the stock price stays above the strike price so the put expires worthless and you keep the premium.
What's the risk here?
The risk is that if the stock price does fall below the strike price, you'll likely be assigned and forced to buy the shares at the strike price. If you haven't set aside the cash, you might have to borrow money or liquidate other positions to meet the obligation. And if the stock has fallen significantly, you could face substantial losses.
How bad could it be?
Let's say you sold those 5 XYZ Nexon C55 puts naked for $4.85 premium, $2,425 total. You hope XYZ stays above $55. But what if it crashes to $45 by expiry?
You get assigned.
You get assigned. You must buy 500 shares at $55, $27,500. Those shares are only worth $45 in the market, $22,500. That's an immediate paper lock of $10 per share, $5,000 total. Your net loss is that $10 loss minus the $4.85 premium you kept, so $5.15 per share, $2,575 total loss.
Significant loss again. Is the loss unlimited like naked calls?
No, not theoretically unlimited. The maximum loss occurs if the stock price falls all the way to zero. In that case, you'd be forced to buy worthless stock at the $55 strike price. Your loss per share would be the $55 strike minus the $4.85 premium received, or $50.15 per share. Still a very substantial loss, but capped because the stock can't fall below zero, unlike a naked call where the stock can rise infinitely.
Okay, so naked put writing is also very risky, just with a defined, though large, maximum loss, unlike naked calls. The key distinction between covered cash-secured writing and naked writing really seems huge in terms of risk profile.
Absolutely massive. Covered and cash-secured writing strategies are linked to a pre-existing asset holding or a concrete plan to acquire the asset. Naked writing is pure speculation on the option premium, divorced from the underlying, carrying much higher potential margin requirements and loss potential.
Great clarification. You also mentioned some corporate use cases for options earlier beyond just financial investors. Can you recap those practical hedging examples?
Sure. Businesses use options strategically for price protection. Let's take currency risk again. A Canadian company knows it needs to pay a supplier US $1 million in 3 months. The current exchange rate is, say, C $1.32 per USO. They're worried the Canadian dollar will weaken, CG go to C $1.40, making the payment much more expensive.
Okay.
They could buy a 3-month USD call option with a strike price of C $1.35. This gives them the right to buy US dollars at C $1.35.
How does it help?
If the rate does rise to C $1.40, they exercise their call option, buying the US $1 million at the C 1.35 strike price. They've capped their cost, plus the premium they paid for the option. If the rate falls favorably to C $1.30, they just let the call option expire worthless, losing the premium, and buy their US dollars cheaper in the spot market at C $1.30. The option gave them upside protection without locking them out of downside benefits.
Flexible insurance. And the oil company example using puts.
Right. A Canadian oil company knows it will have 1 million barrels of oil to sell in 6 months. The current price is US $40 per barrel. They're worried the price might collapse before they sell.
So they want a floor price.
Exactly. They could buy put options on 1 million barrels with a strike price of, say, US $38. This gives them the right to sell their oil at US $38.
And the outcomes.
If the oil price falls below US $38, say to $38, they exercise their puts and sell their oil at the guaranteed US $38 strike price. Their effective price is $38 minus the put premium, much better than $30. If the oil price rises above US $38, say to $50, they let the puts expire worthless, losing the premium, and sell their oil at the higher $50 market price. Again, the option provides downside protection while allowing participation in upside gains, less the premium cost.
These corporate examples really show how options can be powerful, flexible tools for managing specific price risks that businesses face every day.
They are indeed. And the different strategies allow users, whether corporations or individuals, to really define their risk exposure and potential reward up front, though understanding the impact of premium cost, time decay, and volatility is absolutely vital. The source also has a strategy payoff table summarizing goals, max profit loss for these core strategies, which is a useful reference.
Excellent. Okay, we've done a deep dive into options. What about the other major category, forwards and futures? You said the key difference here is that they involve a firm obligation for both parties.
That's the absolute fundamental difference from options. With forwards and futures, the buyer makes a binding agreement to buy the underlying asset on a specific future date at a price agreed upon today. And the seller makes a binding agreement to sell that same asset on that same future date at that same agreed-upon price. Both parties have a firm obligation. There's no walking away just because the price moved against you.
Okay, so no choice involved, like with options. You are locked into that future transaction at today's price unless you get out of the contract somehow.
Exactly, unless you close out the position before expiry. Now, a forward contract is the basic, often customized version of this agreement.
Like the OTC version.
Precisely. Forward contracts typically trade in the over-the-counter OTC market directly between two parties, often a bank and a corporate client. Because they're OTC, their terms are highly flexible. The exact quantity, quality specifications, delivery date, and even the underlying asset can be tailored to the specific needs of the two parties. They're very common for managing interest rate and currency exposures.
And because they're OTC, they carry that higher counterparty default risk we talked about.
Yes, that's the main drawback. Since it's just two parties, there is a greater risk that one might default if the market moves sharply against them. Although, as mentioned, sometimes performance bonds or collateral arrangements are used in the OTC market to mitigate this risk somewhat.
Okay, so forwards are the customized OTC agreements with obligations. What about futures contracts then? They're the exchange-traded version.
Exactly. When a forward-type agreement is standardized and traded on an organized exchange, like the Montreal Exchange or the CME, it becomes a futures contract. This brings all those benefits of exchange trading we discussed earlier.
Remind me of those key benefits again.
The big ones are standardization, uniform contract terms making them fungible, high liquidity, easy to enter and exit positions by offsetting, and the crucial clearinghouse guarantee. The clearinghouse steps in, becoming the buyer to every seller and seller to every buyer, which significantly reduces that counterparty default risk for participants.
Right, the clearinghouse takes on the risk, managed by margin. So futures are essentially standardized, exchange-traded forward contracts with much lower default risk.
That's a perfect way to summarize it. Same core idea, agreeing today on a price for a future transaction, but a very different market structure, risk profile, and level of accessibility. Futures are also broadly classified into financial futures on stock indexes, bonds, currencies, interest rates, and commodity futures on metals, energy, agricultural products, even forest products.
Okay. What's the key terminology we need for futures?
Pretty straightforward. If you agree to buy the underlying asset later via a futures contract, you are said to have a long position, or your long futures.
Long means buy later.
Right. If you agree to sell the underlying asset later, you have a short position, or your short futures.
Short means sell later.
Yeah.
Got it. Is there an upfront cost like the option premium?
No, there's no upfront premium paid between the buyer and seller just to enter into the futures contract itself. You're simply agreeing on the price for that future transaction. The cost comes in the form of the margin deposit required by the clearinghouse.
Okay, no premium, just margin. Now, you said delivery can happen, but most positions are offset.
Yes. Well, the contract technically implies eventual delivery of the underlying asset for commodity futures or final cash settlement for financial futures. The vast majority of futures contracts estimates are often over 98% are offset before the expiration date.
By doing the opposite trade.
Exactly. A long closes out by selling an identical contract. A short closes out by buying an identical contract. This cancels the obligation. Physical delivery, or final cash settlement, only occurs for the very small percentage of contracts that are held open right through to the final expiration.
And you mentioned cash-settled futures. What are those again?
These are common for financial futures, especially stock index futures, where physical delivery of the underlying basket of stocks would be impractical. Instead, at expiration, a final cash payment is made between the long and short parties, based on the difference between the original futures contract price and the final settlement price of the index on that day. All gains and losses are squared up with cash.
Makes sense for things you can't easily deliver.
Yeah.
Now, let's revisit margin requirements and marking to market because they seem absolutely central to futures.
They are fundamental to the integrity of the futures market. As we said, both the buyer and the seller, short, must deposit funds with their broker, held by the clearinghouse, as a good faith deposit or performance bond. This is the margin.
And there are different types of margin.
Yes. There's the initial margin, which is the amount required to open a new futures position. And there's the maintenance margin, which is a slightly lower level. Your account balance must always stay above the maintenance margin level.
But if it drops below?
If daily losses from the marking to market process cause your account balance to fall below the maintenance margin level, you receive a margin call from your broker. This demands that you immediately deposit additional funds to bring your account balance back up, usually all the way back to the initial margin level.
So that marking to market process is constantly adjusting your account balance based on the day's price movements.
Every single day. It's a crucial daily process. The clearinghouse determines the official settlement price for each contract at the end of the trading day. All open long positions are credited if the price went up, debited if it went down. All open short positions are debited if the price went up, credited if it went down.
So gains and losses are realized, or at least accounted for, daily, not just when you close the position.
Exactly. Your account reflects the current value of your position daily. This ensures that losses are covered promptly, preventing them from accumulating into unmanageable amounts that could threaten the clearinghouse and the market. It maintains financial integrity.
Can we walk through that Greg and Layla example quickly to see it in action?
Sure. Let's say Greg goes long, buys one futures contract, and Layla goes short, sells the same contract. The initial margin required is $2,000, and the maintenance margin is $1,500. Both deposit $2,000.
Okay, both start with Tuesday.
Day one. The futures price rises by an amount equivalent to a $200 gain for Greg's long position. So Greg's account is credited $200, now $2,200. Layla's short position lost $200, so her account is debited $200, now $1,800. Note that Greg's gain is Layla's loss is zero-sum financially.
Okay.
Day two. The price drops, causing a $300 loss for Greg. His account is debited $300, down to $1,900. Layla's account is credited $300, up to $2,100. Greg's account is still above the $1,500 maintenance level.
So, okay.
Day three. The price drops again, a bigger loss of $500 for Greg. His account is debited $500, bringing it down to $1,400, $1,900, $500. Layla's account is credited $500, up to $2,600.
$1,300 is below the $1,500 maintenance margin.
Exactly. Greg immediately gets a margin call. He must deposit enough funds to bring his account back up to the initial margin level of $2,000. Since he's at $1,400, he needs to deposit $600. If he doesn't meet the margin call promptly, his broker will forcibly close out his position to prevent further losses.
Wow, okay. That daily settlement and margin call process really keeps things tight and ensures losses are covered right away. It feels much more active and potentially demanding than holding an option.
It absolutely is. And it relates directly to the very high degree of leverage inherent in futures trading.
How high is the leverage typically?
The margin requirement, that initial deposit, is usually only a small percentage, often just 3% to 10% of the total value of the underlying asset controlled by the futures contract.
So like a $3,000 deposit might control $100,000 worth of oil or currency.
Exactly that kind of ratio.
Yeah.
A small deposit controls a very large nominal value.
And the consequence of that high leverage.
Just like with options, but perhaps even more pronounced with futures due to the daily marking to market and margin calls. Leverage massively amplifies both potential profits and potential losses.
Right.
A small percentage move in the underlying asset's price can result in a huge percentage gain on your margin deposit if you're right, or a huge percentage loss if you're wrong. And because losses are debited daily and can exceed your initial deposit,
Yes.
it is absolutely possible to lose more money than you initially deposited in your futures account if prices move sharply against you and you have to meet margin calls, or fail to meet them and get liquidated at a loss.
Another critical warning. Futures leverage requires extremely careful risk management.
Non-negotiable. You have to understand margin, marking to market, and the potential for losses exceeding your initial stake.
Okay, let's look at some real-world strategies using forwards and futures now. How are they typically employed?
Well, because the structure is simpler than options, just long or short, obligating both sides, the strategies tend to be more straightforward applications of speculation or hedging.
Okay, let's start with buying futures. Long position. When would you do that?
Two main scenarios again. One, to speculate that the price of the underlying asset is going to increase. You buy futures today, hoping to sell them back at a higher price before expiry, or take delivery cash settlement if you hold to the end.
Like betting on gold going up.
Exactly. An investor thinks gold, currently 1,800 ounces, is heading higher. They buy one gold futures contract, representing 100 ounces, at a price of, say, $1,805. If the futures price rises to $1,855, they can sell their contract, offset the position, for a profit of $50 per ounce. $1,855 sell price, $1,805 is buyer price, which is $5,000 profit on the contract, 100 ounces, 50 ounces.
Okay, straightforward bet on price increase. What's the hedging use for buying futures?
Buying futures is used to hedge by locking in a future purchase price. This is for someone who knows they will need to buy the underlying asset in the future and wants to protect themselves against the price rising before then.
Like a company needing the asset.
Yes. Think of a jewelry manufacturer who knows they'll need 100 ounces of gold in 3 months to make their products. They're worried the price of gold might surge by then. They can buy gold futures contracts today, effectively locking in the purchase price around today's futures price. If the actual market price of gold, the spot price, is much higher in 3 months,
Yeah.
the higher cost they pay for the physical gold will be offset by the profit they make on their long futures position when they close it out. They've protected their input cost.
Okay, so buying futures. Speculate on rise or hedge against rise if you need to buy later. Now, selling futures, short position.
Same logic, reversed.
Yeah.
1. To speculate that the price of the underlying asset is going to decrease. You sell futures today, hoping to buy them back later at a lower price before expiry.
Like betting on oil prices falling.
Perfect example. An investor thinks crude oil, currently $70 a barrel, is likely to fall. They sell one oil futures contract, representing 1,000 barrels, at a price of, say, $69.50. If the futures price then drops to $65.50, they can buy back an identical contract, offset the position, for a profit of $4 per barrel. $69.50 sell price, $65.50 buy price. That's $4,000 profit on the contract, 1,000 barrels, 4 barrel.
Simple bet on price decrease. And the hedging use for selling futures.
Selling futures is used to hedge by locking in a future selling price. This is for someone who owns or will produce the underlying asset and wants to protect themselves against the price falling before they sell it.
Ah, like our farmer.
Exactly like our farmer. A corn farmer expects to harvest 5,000 bushels in September. They're worried corn prices might be much lower by then. They can sell corn futures contracts today, effectively locking in a selling price around today's futures price for their upcoming harvest. If the actual market price for corn collapses by September, the lower revenue they receive when they sell their physical corn will be offset by the profit they make on their short futures position when they buy it back. They protected their selling price and stabilized their income.
That farmer example really clicks for hedging with futures. Now, the source had that more detailed scenario about the brewery using barley futures. Can we walk through that? It seems like a great real-world corporate hedging example.
Absolutely. It's a fantastic illustration of how companies use futures for price risk management, even if they don't intend to take delivery through the exchange.
Okay, set the scene.
So we have a brewery that knows it will need 100 tons of malting barley in October to make beer. The current spot price for immediate delivery is $150 per ton. The price for October barley futures contracts trading on the exchange is $155 per ton. The brewery's regular barley supplier has agreed to sell them the 100 tons in October, but the price will be whatever the spot market price is at that time in October.
Okay, so the brewery is exposed to the risk that the spot price in October could be much higher than $150 or $155.
Exactly. They want to lock in a cost closer to today's levels. So what do? They implement a hedging action. They buy 5 October barley futures contracts today at the $155 price. Assuming each contract is for 20 tons, 5 contracts cover their 100-ton requirement. 520 equals 100.
So they're long 100 tons of barley futures at $155. This protects them against a price increase.
Correct. Now, let's fast forward to October. The brewery needs the actual physical barley. Let's say the spot market price for barley has indeed risen significantly, maybe to $170 per ton. And the October futures contract price, which is now very close to expiring, is trading at $171 per ton.
Okay, prices went up. What does the brewery do? They need the physical barley from their supplier, not from the futures exchange.
Right. First, they deal with their futures position. Since they don't want delivery via the exchange, they offset their futures position. They were long 5 contracts, and now they sell 5 identical October barley futures contracts at the current futures price of $171.
Okay, bought at $155, sold at $171. What's the result of that?
They made a profit on their futures trade. The profit is $171 selling price, $155 buying price, equals $16 per ton. Since they had contracts covering 100 tons, their total profit from the futures position is $1,600, 100 tons, 16 tons.
Okay, $1,600 profit from the hedge. Now they still need the actual barley.
Yes. They go to their regular supplier and buy the 100 tons of physical barley they need at the current spot market price, which we said was $170 per ton. So the cost for the physical barley is $17,000 100 ton, 170 ton.
So they paid $17,000 for the barley. It made $1,600 on the futures hedge. What's their bottom line cost?
Let's calculate the effective price they paid per ton. Their physical cost was $170 per ton, but they had that $16 per ton profit from their futures hedge. So their net effective cost is $170 physical cost, $16 futures profit, only $154 per ton.
Wow. So even though the market price jumped from $150 up to $170, a $20 increase, their hedge meant their final effective cost was only $154. That's incredibly close to the $155 futures price they initially locked in.
Exactly. The hedge worked almost perfectly. It shows how companies use futures primarily for price protection, to turn an uncertain future cost into a much more predictable one, closely related to the futures price at the time they place the hedge. They rarely intend to make or take delivery via the exchange. They use it purely as a financial risk management tool.
That slight difference, $154 effective versus $155 initial futures, is that normal?
Yes, that's due to what's called basis risk. The basis is the difference between the spot price and the futures price. It can fluctuate slightly, so hedges aren't always mathematically perfect down to the penny, but the goal is achieved. Reducing unpredictable price volatility down to a much smaller, more manageable basis risk. Predictable cost is much better for business planning than wide-open price exposure.
That brewery example makes the value of hedging with futures crystal clear. And again, the speculators play a role here.
Absolutely vital. For the brewery wanting to buy futures to lock in a price, there needs to be someone else willing to sell those futures. Maybe a farmer hedging their crop, or a speculator betting the price will fall. Speculators absorb the risk that hedgers want to offload, and in doing so, they provide the essential liquidity that makes these markets work efficiently.
Fascinating interplay. Okay, we've covered the big ones: options, forwards, and futures. The sources also mentions some special derivatives, rights and warrants. How do they fit in?
Rights and warrants are interesting because they share some similarities with stock call options, but have one crucial difference. Like call options, they give the holder the right, but not the obligation, to buy a specific amount of the company's stock at a set price, the exercise or subscription price, on or before an expiration date.
Okay, so far sounds just like a call option. What's the crucial difference then?
The crucial difference is who issues them. Rights and warrants are issued directly by the company itself, usually as a way to raise capital. Standard exchange-traded call options, on the other hand, are typically created and traded between other investors or market makers. The company isn't involved in their creation.
Hmm. Why does it matter who issues them?
It matters fundamentally because of what happens when they are exercised. When a right or warrant is exercised, the holder buys the shares directly from the company. This means the company issues OBW shares and receives cash from the sale. This increases the total number of shares outstanding.
Potentially diluting existing shareholders.
Exactly. It can dilute the ownership percentage of existing shareholders if they don't participate. When a standard call option is exercised, however, it's usually just an exchange of existing shares between two investors. The call holder buys shares from the call writer. No new shares are created by the company.
Got it. Company-issued rights warrants means new shares and potential dilution. Investor-created options means existing shares are exchanged. That's a key distinction. What about their typical lifespan? Are they different there too?
Yes, very different. Rights are typically very short-term instruments. They usually expire in just 4 to 6 weeks. Warrants, however, are generally long-term, often lasting for 3 to 5 years, sometimes even longer.
Weeks versus years. Big difference. Tell me more about rights. Why would a company issue something so short-term?
A company issues rights, conducting a rights offering, when it wants to raise new equity capital by selling new common shares. But it wants to give its existing shareholders the first opportunity to buy them. It's seen as a way to let current owners maintain their proportional ownership stake if they choose to invest more.
And they're given to existing shareholders for free.
Yes, existing shareholders receive the rights automatically, based on how many shares they own on a specific record date, at no cost. The rights give them the privilege to buy a certain number of new shares, for example, 1 new share for every 5 rights held, at a specific subscription price or offering price.
And that subscription price?
It's almost always set at a discount below the current market price of the stock at the time the rights are issued. This discount is what makes the rights valuable.
Okay, so existing shareholders get this short-term opportunity to buy more shares directly from the company at a discount. You mentioned cum rights and ex rights.
Right. For a period before the record date, the stock trades cum rights, meaning with rights. If you buy the stock during this period and hold it through the record date, you will receive the rights. On a specific date called the ex rights date, the stock starts trading ex rights, without rights. The stock price typically adjusts downwards on the ex rights date by roughly the theoretical value of 1 right, and the rights themselves often start trading separately on an exchange for their short lifespan.
So, as a shareholder who receives rights, what can I do with them?
You generally have a few choices before they expire. 1. Exercise the rights, pay the subscription price, and buy the new discounted shares. 2. Sell the rights if they are traded on an exchange. You can sell them to someone else who wants to exercise them. 3. Buy more rights in the market if you want to purchase more new shares than your initial allotment allows. Or 4. Do nothing. Let the rights expire worthless, which means you lose the value inherent in that discount.
And because they're so short-term, their value is mostly that discount, not much time value.
Exactly. Their value is primarily their intrinsic value, driven directly by the difference between the higher current market price of the stock and the lower subscription price, adjusted for how many rights are needed per new share. There's very little time value because they expire so quickly. The source provides formulas for calculating this intrinsic value, depending on whether the stock is trading cum rights or ex rights.
Okay, so rights are a short-term, company-issued privilege for existing shareholders to buy new, discounted shares to help the company raise capital.
That's the essence of it.
Now, warrants. You said these are the long-term version, also issued by the company. Why issue these? Often used as a sweetener, you mentioned.
Yes, that's a very common use. Warrants, giving the holder the right to buy shares directly from the company at a set exercise price for a long period, years, are frequently attached as an extra incentive to new issues of the company's bonds or preferred shares.
Why would a company bundle warrants with bonds or preferreds?
It makes the primary security, the bond or preferred share, more attractive to investors. The warrant offers a potential bonus, a chance for a delayed equity kicker, if the company's common stock price performs well and rises significantly above the warrant's exercise price over its multi-year life.
So it sweetens the deal for the investors buying the bonds.
Exactly. And because investors value this potential upside from the warrant, the company might be able to offer a slightly lower interest rate on the bond or lower dividend rate on the preferred shares than they could otherwise. It helps the company lower its cost of capital.
Clever. So warrants are long-term call options issued by the company, often as part of a package deal. Do they have intrinsic and time value like options?
Yes, absolutely. A warrant will have intrinsic value if the current market price of the stock is above the warrant's stock price, exercise price. And because they have such long expiration dates, years, they typically have significant time value as well, reflecting the substantial potential for the stock price to appreciate over that extended period. The warrant's market price equals IV plus TV.
And why would an investor specifically buy warrants, maybe in the secondary market after they're issued? Is it that leverage potential again?
Yes, leverage is a key attraction. Just like with standard call options, the price of a warrant is usually much lower than the price of the underlying stock, but it tends to move directionally with the stock. This means the percentage gain on a warrant could potentially be much, much greater than the percentage gain on the stock itself if the stock price rises significantly.
Can you illustrate that leverage like the example in the source?
Sure. Imagine a warrant has a market value of $4. Its exercise price is $12, and the underlying stock is currently trading at $15. So the warrant has $3 of intrinsic value, $15 stock, $12 exercise price, and $1 of time value, $4 mark price, $3 RV.
Okay, $4 warrant, $15 stock.
Now, let's say the stock price rises substantially, maybe to $23. That's an $8 increase or a 53% gain on the stock, $8, $15.
Good gain on the stock. What happens to the warrant?
The warrant's intrinsic value is now $11, $23 stock, $12 exercise price. Assuming it still has some time value, its market price will rise to at least $11, maybe more. Let's just say it goes to $11. The warrant went from $4 to $11. That's a $7 gain. On a $4 initial investment, that's a 175% return, $4.
Wow, 53% gain on the stock becomes 175% gain on the warrant. Huge amplification. But the
It's
downside.
the same amplification. If the stock falls instead, say from $15 down to $10, a $5 loss or 33% drop.
Yeah.
The warrant loses all its intrinsic value. Since $10 stock, $12 exercise, its time value will also plummet. It might fall to just $1.25. On a $4 initial investment, that's a 94% loss. On a $4 initial investment, that's a 94% loss.
So 33% stock loss becomes a 94% warrant loss. Leverage cuts both ways dramatically, just like with options.
Exactly. Warrants offer significant leverage potential, both up and down, over their long lifespan.
Okay, so wrapping up this special category, rights, warrants, and standard call options all give the holder a right to buy stock, but they are fundamentally different instruments.
Crucially different. Key distinctions are issuer, company for rights warrants versus other investors, market makers for options. Purpose, raise capital sweetener for rights warrants versus speculation hedging income for options. Lifespan, very short for rights versus long for warrants versus variable for options. Initial cost, free to shareholder Sparta unit for rights warrants versus premium employment for options. And impact on shares. New shares issued, potential dilution for rights warrants versus exchange of existing shares for options. Understanding these differences is vital.
That's a great summary table in my head. Okay, we have covered a massive amount of ground today. We've gone from the basic idea of what derivatives are, looked at the underlying assets, the different markets, OTC versus exchange, the players involved, and their motives. Then dive deep into the mechanics and strategies for options, forwards, futures, and even rights and warrants, with lots of examples along the way. What are the absolute core principles, the big takeaways listeners should hold on to from all this?
I think a few core concepts really tie everything together. Firstly, and maybe most importantly, is leverage.
Can't emphasize that enough.
Right. It's an incredibly powerful force inherent in most derivatives. It enables control over large contract values with relatively small amounts of capital, premium or margin. But this power amplifies both potential gains and, crucially, potential losses. This is where the highest risks often lie, especially with futures trading or naked option writing, where losses can exceed the initial investment. Understanding and respecting leverage is paramount.
Okay, leverage is key. What else?
The fundamental dynamic of risk versus reward and how derivatives allow this to be managed or sought. They are fundamentally tools for transferring risk. They allow risk to be precisely shifted from those who want to avoid it, the hedgers like our farmer or brewery, to those who are willing to take it on in the hope of potential profit, the speculators.
And that leads to the hedging versus speculation distinction.
Exactly. It's the two primary uses. The same instrument An oil future, a stock call option, can serve vastly different goals depending on the user's intent. Is it being used to offset an existing business risk? Hedging, generally seen as risk reducing for that entity? Or is it being used to make a directional bet on price movements? Speculation, taking on risk. The motivation is key.
Right. And finally,
Just the importance of understanding your instrument. Each type of derivative options, futures, forwards, rights, warrants, has unique mechanics, unique payoff structures, different rights versus obligations, and distinct risk profiles. A call option behaves differently from a put option, and a futures contract is fundamentally different from both in terms of obligation and margin requirements. You need to know the specifics of the tool you're using.
and don't forget transaction costs, right?
Always. Brokerage commissions for exchange-traded products or the bid-ask spreads and embedded fees in OTC contracts absolutely affect your net results and need to be factored into any strategy. They're not insignificant.
So bringing it all together, what does this mean for you, the listener, who's stuck with us through this deep dive?
Well, hopefully by understanding these tools, the core concepts like leverage and moneyness, the markets they trade in, the motivations driving different players like hedgers and speculators, and the mechanics of key instruments like options and futures, you gain a much clearer, more nuanced view of the financial world.
Less intimidating, maybe.
Exactly. You can better interpret company financial reports when they talk about hedging programs, understand news headlines about market volatility or specific trades, and appreciate the complexity behind various investment strategies. You've hopefully moved beyond just the scary headlines to grasp their integral role, for better or worse sometimes, in managing risk and facilitating economic activity in our complex global economy.
So they've gone from maybe just an intimidating finance buzzword to, well, a fundamental piece of the financial system's plumbing, really.
That's a great way to put it. They are powerful, they are versatile, and being well-informed about how they work and the risks they entail is really key in today's world.
Okay, so here's a final thought to leave you with, building on what we've discussed. We've seen how these instruments allow one party to essentially offload risk they don't want, while another party willingly takes it on, hoping for profit. How does this intricate, constant dance of risk transfer actually shape the broader economy and potentially influence the stability or instability of the financial system itself?
That's a deep question, and one regulators and economists grapple with constantly. Definitely something worth pondering.
Indeed. Well, that brings us to the end of this deep dive into the world of financial derivatives.
We sincerely hope that breaking down these sometimes complex concepts and walking through plenty of practical examples has made this topic feel much more accessible and understandable.
Yeah, keep exploring these ideas. Understanding tools like these, even conceptually, is really invaluable for navigating the financial news and landscape around us.
Thanks so much for joining us.